Hi everyone, today we'll be going over accounts October-November 2021, paper 3-1, question number 5. This is structured paper 3, which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 5 is of section B, which relates to cost and management accounting. Without any further delay, let's get started. AR PLC has been setting its budgets for 2022. It has prepared the following production budget in units. So the production budget consists of the opening inventory for each of the first 6 months of the year 2022. Then we have the production level for those particular months. Then we have the sales level for those particular months in order to figure out our closing inventories. Now we are also given the following additional information. For the first one, we are given the variable cost of each unit. And for direct materials, that's 8 meters at 5 per meter for each particular unit. And this expense of direct material is paid in the month following purchase. It means that for the direct material that we purchased in the month of January, we will be paying the expense in the month of February. For the direct labor, the rate is normally 80 and this is per unit, and it is paid in the month of working, meaning that the direct labor invested in the month of January will be paid for in that particular month. And when more than 140 units are produced in any one month, an overtime premium will be paid amounting to an extra $10 for each unit in excess of 140. So labor, we have a basic rate of 80 per unit, and that's the basic. Let's write it down. Then we have the overtime rate of $10 for units excess in 140. Then for the third one, we have variable overheads of the rate 25 per each unit, which is paid in the month of production, meaning that for the goods that we produce in the month of January, the variable overheads will be paid in that particular month. For the second information, we are given that it is the policy of the company to maintain an inventory of direct materials. So we're only talking about the inventory of direct materials, not the inventory of goods, equal to 1/4 of the quantity needed in the coming month. So let's talk about the month of January and February. If for the February we have the direct materials amounting to 1,000, then the direct materials for the closing inventory in the month of January should be 1/4 of this particular amount. So if for February we have 1,000, then the direct materials as the closing inventory in the month of January will be 1,000 by 4, which is 250. So this is the policy of the company. Then for the third one, the directors plan to replace a substantial amount of machinery in April 2022. The new machinery will cost 13,000 and the sale proceeds of the old machinery are expected to be 2,000. So we will be selling our old machinery in the month of April, for which we will be receiving the amount of 2,000, and in that particular month we will also be investing in a new machinery for which we will have to pay out the amount of 13,000. For the fourth information, we are given that other running costs of 3,800 are expected to be paid monthly. Alright, then for the fifth one, we are given that the selling price is expected to be 200 per unit. And 25% of sales are cash sales and 75% are credit sales. And this will be the same rate for each of the first 6 months for the year 2022. Credit customers pay in full in the month after the sale. Alright, so if we have cash sales, then the amount received will be in that particular month, right? For the credit sales, if the goods are sold in the month of January, then the payments will be received in the month of February. And we are not providing any sort of discount, so the credit customers will pay in full. For the sixth one, we are given the balance on the bank account on 1st March 2022, which is expected to be 1,700. For the first part of this question, we need to prepare the purchases budget for direct materials in dollars for each of the months February, March, and April 2022. Alright, if we're talking about purchases budget for direct materials, we actually need to figure out the total amount worth of direct materials that we need to purchase in the month of February, March, and April. In order to figure that out, we need to consider the production level for the months of February, March, and April. For the goods produced in those particular months, what amount of direct materials do we require? We first will calculate that particular amount. So let's have a look at our above information. We can see right here, the production level is given. And we're only making our purchases budget for the month of February, March, and April. So we will be focusing on these particular 3 months while talking about production. So the production level for February is 130. but we know that while making our purchases budget, we will be making that in dollars. So we need to find out the dollar value worth of direct materials that we need for the production level of 130. And what we know is that the direct material for each unit is required at 8 meters at $5 per meter. So if we're talking about February, the production level is 130. That's the number of units. And for each unit, we require 8 meters of direct material. So we can just multiply it with 8. And for each meter of direct material, we require to pay $5. So we just multiply it with $5. So this will give the direct materials required for production in the month of February, which is 130 times 8 times 5. That gives us 5,200. All right, let's repeat the same process for the month of March and April. For March, the production level is 148. So that's just going to be 148 times 8 times $5. This gives the direct material used in production for the month of March to be 5,920. All right, repeat the same process for the month of April. We can see that the production level is 159. So that's just going to be 159 times 8 times $5. This gives the direct materials used in production for the month of April to be 6,360. So we will now record these three amounts in our purchases budget under the heading of production. Let's do that. All right, we'll be starting with production. And for February, we figured it out to be 5,200. For March, that was 5,920. And for April, we had 6,360. Now we will add the closing inventory to our production. So that's closing inventory. Now, if you remember correctly, in the additional information, we were given the policy regarding the closing inventory of direct materials right here. So it is a policy of the company to maintain an inventory of direct materials equal to 1/4 of the quantity needed in the coming month. So if we are to figure out our closing inventory for the month of February, that's just going to be 1/4 of the production level in March. So the closing inventory for February is just going to be 5,920 divided by 4. That's 1/4. That will be 1,480, which is the closing inventory for the month of February. Now, in order to figure out the closing inventory for the month of March, that's just going to be the quarter of production in the month of April. So that's 6,360 divided by 4, which is going to be 1,590. Let's write it down. Now, in order to figure out the closing inventory for the month of April, we definitely require the production for the month of May. Let's figure out the production for the month of May. We can see that the production level for the month of May is 138 units, which is given right here. So for May, that's just going to be 138 times 8, because each unit requires 8 meters of direct material. And we multiply it with $5 because that is the rate of direct material per unit. So this gives the total direct material required for the production in the month of May to be 5,520. Now, we know that 1/4 is going to be the closing inventory for the month of April. So that's just going to be 5,520 divided by 4, which is 1,380. So this is going to remain as the closing inventory level for the month of April. Let's write it down in our purchases budget. That's 1,380. All right, now we will total our production and the closing inventory. So for February, that's 5,200 plus 1,480, which results in 6,680. For March, that's 5,920 plus 1,590, which results in 7,510. For April, that's 6,360 plus 1,380, which results in 7,740. Now we just deduct our opening inventory. So for opening inventory, it is quite easy because the closing inventory of last month will be the opening inventory of current month. So if we're talking about February, then the closing inventory of January will actually be the opening inventory for February. And we know that the closing inventory for January is just going to remain at the quarter level of production in the month of February. So closing inventory in January is just going to be 5,200 divided by 4, which is 1,300. So if this is the closing inventory for January, then this will definitely be the opening inventory for February. Let's write it down. And we are deducting our opening inventory. So let's write it down in a bracket indicating that this needs to be subtracted. Now for the month of March, the opening inventory is going to be the closing inventory for the month of February. So that's just 1,480. So we repeat the same process for April. That's just going to be the closing inventory for the month of March, which is 1,590. All right, now if we deduct the opening inventory from the total of production and closing inventory, we can easily figure out the purchases required to be made for direct materials for these 3 months. For February, that's going to be 6,680 minus 1,300, which is 5,380. For the month of March, that's 7,510 minus 1,480, which is 6,030. Then for the month of April, that's 7,740 minus 1,590, which results in 6,150. This concludes the first part of this question. Now we can move to the second one. We now need to prepare the cash budget for each of the months March and April 2022. And whenever we're preparing the cash budget, we actually segregate it into 2 different sections. So the first one is receipts section. Let's write it down. So the major source of receipt is definitely going to be the sales. Let's have a look at the above information. Okay, it's given in the 5th point. The selling price is expected to be 200 per unit, and 25% of sales are cash sales. So whatever number of units that we sold in the month of March, 25% of those is going to be cash sales, meaning that for the sales made, 25% of it is going to be received in this particular month. Then 75% are credit sales, meaning that the 75% we do not receive the cash right away, and the credit customers pay in full in the month after the sale. So if we are making the sales in the month of March, then the 75% of it are going to be credit sales, and for that particular credit sales we will be receiving the amount in the next month, which is going to be April, right? First, let's figure out our cash sales for the month of March and April. Let's have a look at our production budget. We are given the sales unit right here. Alright, so for the month of March, the sales unit is 150. Let's figure out our cash sales. So I'm going to write it down here. For March, the total number of units sold is 150. 25% of it is going to be of cash sales. So that's times 0.25. And we know that the selling price per unit is 200. So let's multiply in order to figure out the total cash sales value in the month of March. That's 150 times 0.25 times 200, which gives 7,500. So this is the value that we need to record in the receipt section of our cash budget under the heading of cash sales. Let's repeat the same process for April. So for April, the total number of sales is 160. Let's write it down. And out of these units, 25% relate to cash sales. So that's 0.25. And we know that the selling price per unit is 200. So this gives the total cash sales in the month of April to be 160 times 0.25 times 200, which results in 8,000. So let's record these two amounts under the heading of cash sales in the receipt section of our cash budget. So that's cash sales, and for March it was 7,500, whereas for April it was 8,000. Alright, now we need to record the credit sales as well. We know that for the credit sales, we receive that particular amount in the next month or the following month. So if we're talking about the receipts in the month of March, we will be receiving for the credit sales made in the month of February. So let's figure out the amount for the credit sales for the month of March. We need to actually record the amount of credit sales made in the month of February. So that's total sales is 130. And 75% of it belongs to credit sales. So that's times 0.75. And we will now multiply it with the sales price per unit of 200. So this gives the total value of the credit sales made in the month of February, which we will be receiving in the month of March. That's 130 times 0.75 times 200, which results in 19,500. We repeat the same process for the amount of credit sales received in April. So this is actually for the credit sales made in the month of March. So the total unit sold in the month of March is 150, and 75% of it belongs to credit sales. So that's 0.75. Now we just multiply it with the selling price per unit of 200. So this gives the amount of credit sales made in the month of March, which we will actually receive in the month of April. So that's 150 times 0.75 times 200, which gives 22,500. So now we will record these two amounts in our receipt section of the cash budget under the heading of credit sales. Let's do that. So we have credit sales, which amounted to 19,500 for March and 22,500 for April. Okay, now let's have a look for any other receipts for these 2 months. Okay, we already made use of fifth one and the second one. Then for the third one, we are told that the directors plan to replace a substantial amount of machinery in April. So we're definitely creating a cash budget for April as well. We need to consider this point. The machinery will cost 13,000. So this is actually the payout, which we will be recording under the payment section. And the sale process of the old machinery are expected to be 2,000. So this is the value that we received for selling our old machinery. So obviously this is a receipt that we need to record for the month of April. Let's write it down in our receipt section in the cash budget under the heading of sale of machinery. That's sale of machinery, and this is in the month of April. We will be receiving 2,000. Okay, so this concludes our receipt section. Let's figure out the total receipts. For the month of March, that's going to be the total of these two amounts. So that's 7,500 plus 19,500, which results in 27,000. Then for the month of April, that's going to be the total of these three amounts. So that's 8,000 plus 22,500 plus 2,000, which results in 32,500. Now we can move to our payment section. So this will record all of the payments that we made in the month of March and April. Let's have a look at the above information. Okay, we are given the running cost of 3,800 expected to be paid monthly, which means that this running cost should be recorded for the month of March and April in our payment section of the cash budget. Let's do that. So we can just record it under the heading of running costs. And that's 3,800, 3,800. All right. So let's talk about direct material. What we know is that the expenses for direct materials are paid in the month following purchase, meaning that for whatever purchases we made in the month of February will be paid in the month of March. And we already figured out the total purchases of direct materials in the first part in our purchases budget. So let's have a look. So the purchases made in February amounted to 5,380, and this amount will be paid in the month of March, meaning that this amount should be recorded as an expense in the payment section in our cash budget in the month of March. Similarly, the purchases of direct materials made in the month of March was 6,030, which means that this will be actually paid in the month of April. So this will be recorded as the purchases of direct materials in the month of April in our payments in the cash budget. Let's record these two amounts. So we can just write it down as purchases. For the month of March, we will be paying the purchases of direct materials made in February, which amounted to 5,380. For the month of April, we will be paying the purchases of direct materials made in the month of March, which amounted to 6,030. All right, let's have a look at above information again. So we are given the direct material rate of 80, and what we know is that the direct material is actually paid in the month of working. So the labor invested in the month of March will be paid in the month of March as well. And we also have the overtime rate of $10 for the units additional units produced greater than 140. So let's have a look at the production level of the month of March, which is 148. So for 148 units, we will provide the basic rate of $80. And for the additional units greater than 40, which is 8, we will also provide the overtime rate at the rate of $10. So let's write it down. We can write it down as labor, and we have a basic rate and an overtime rate. So for March, we have the total production level of 148. We need to provide a basic rate for these total units, right? So the basic rate is 80, which gives the amount to be recorded in our cash budget to be 11,840. So that's the basic rate. Then the additional unit greater than 40 is 8. So we need to provide an overtime of $10 for those units, which is going to be 80. Okay, now we repeat the same process for the month of April. Let's have a look above in order to figure out our production level. So for April, the production level is 159. Okay, let's perform the required calculations. Out of 159, we need to provide the basic rate for those total units. So that's 80. That's 159 times 80, which gives our basic rate to be 12,720. Let's record it. And for overtime, that is for the units greater than 140. So greater than 140, that's 19 units, right? So for 19 units, we will be providing an overtime rate of $10. So that's 190. Let's record it. Okay, now we also have the variable overheads. And variable overheads are paid in the month of production. So we just need to multiply 25 to the total units of production, which is 148 for the month of March and 159 for the month of April. Okay, so that's variable overheads. For the month of March, that's 148 times 25, which gives the total variable overheads to be 3,700. Then for the month of April, the total units is 159 times the variable overhead rate of 25, which gives our total variable overheads for the month of April to be 3,975. Okay, let's have a look at the above information again. So we are done with number 1. We are done with number 2. For number 3, there was a purchase of new machinery in the month of April, which means that we need to pay for that particular purchase, right? And it amounted to 13,000. So we need to record this amount of 13,000 in the month of April in our payment section of cash budget under the heading of new machinery. Let's do that. So that's new machinery. Okay, and this was for the month of April. That's 13,000. Now we can just figure out our total payments. For the month of March, that's just going to be the total of these 5 amounts. So that's 3,800 plus 5,380 plus 11,840 plus 80 plus 3,700, which results in 24,800. For the month of April, that's going to be the total of these 6 amounts. So that's 3,800 plus 6,030 plus 12,720 plus 190 plus 3,975 plus 13,000, which results in 39,715. Now we figure out our net cash. So net cash is just going to be the difference between the total receipts and total payments. So for the month of March, that is just going to be 27,000 minus 24,800, which results in 2,200. For the month of April, that's going to be 32,500 minus 39,715, which results in the negative balance of 7,215. All right, now we just need to adjust the opening balances. So that's balance brought forward. And we figure out our closing balance, which is balance carried forward. Okay, we are given the information regarding the opening balance for the month of March. Right here. So the balance on the bank account on 1st March is expected to be 1,700. So let's record this under the heading of balance brought forward, which is 1,700. Now, in order to figure out the closing balance or the balance carrying forward, we just adjust our net cash to the balance brought forward. So that's just going to be the sum of these two amounts, which is 2200 plus 1700, which results in 3900. So the closing balance for this month is going to be the opening balance for next month. So that's 3900. Now, in order to figure out the closing balance for the month of April, we just need to adjust the net cash to the opening balance for that particular month, which is the sum of these two amounts. So that's minus 7215 plus 3900, which results in a negative balance of 3315. This concludes the cash budget as well as the second part of this question. Now we can move to the third one. We need to comment on the suitability of the month of April for the replacement of the machinery, because we are selling the old machinery for the rate of 2,000 and we are purchasing the new machinery at the rate of 13,000 in the month of April. So firstly, let's have a look at the production level. So we can see that the production level for April is 159, which is the highest for the first 6 months of the year 2022. Let's write it down. So production level is highest in the month of April. So since the production level is highest, it is the month in which the company is least able to cope with the possible disruption of production, because if we're talking about machinery, it obviously disrupts our production flow, right? Let's write it down. And therefore, it is the month in which the company is least able to cope with a possible disruption of production. Secondly, if you look at our cash budget, we can see that there is a negative cash balance for the month of April, right? That's 7,215 negative balance. So we can say that the funds are not available in April to pay for the new machinery without resulting in an overdraft, because the closing balance is obviously a negative balance, which means that it is an overdraft. Let's write it down. So funds are not available in April to pay for the new machinery without resulting in overdraft. Alright, this concludes the third part of this question. Now we can move to the fourth one. One of the directors has suggested that the company limit production to 140 units every month to avoid having to pay the overtime premium and so reduce costs. We need to advise the directors whether or not they should limit production to 140 units a month. We need to justify our answer. So let's have a look at our production budget first. So if we limit our production level to 140, that's going to be the production level for 6 months, right? So that's 140 times 6. This gives the total units to be produced in these 6 months, which is 840 units. And we also have an opening inventory of 35 for the month of January. So if we are to add that, that results in 875 units available for the first 6 months of the year 2022. So let's add up the sales amount. So that's 120 plus 130 plus 150 plus 160 plus 140 plus 100. So this gives the total sales for the first 6 months of 2022 to be 800 units. So even if we restrict the production to 140 units, we can easily sustain our sales of 800 with the available units of 875. Let's write it down. the company could restrict production and still manage the level of sales. But with the restriction of production units, there might be an additional risk of shortage of finished goods. So let's write it down as well. The risk of shortage of finished goods may arise. And what we know is that the normal rate for labor is 80, whereas the overtime rate is 10. So we can say that the cost of overtime is very small as compared to the basic labor cost. The cost of overtime is very small as compared to the basic labor cost. Okay, based on these factors, we can make a decision now. So I would personally advise the directors to not limit production to 140 units a month, because the sales unit that are given in our production budget is just an estimation, and the sales unit can be greater than that. And if that is the case, then there might be a risk of shortage, which we do not want. So let's write it down. The directors should not limit production to 140 units a month. This concludes our fourth part of the question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.